when I'm talking about long or short, I own physical metals and I'm not selling them. Okay. But there's times I may have a partial short position as a trade. From a trader standpoint, I think that gold's probably going back to 3,000. Okay. We talked about last time we talked, I said it would get to 3,500. It did. I thought silver would get close to 40. It did. I think they're both going to pull back a little bit. But again, if you're an investor, you should be buying it and holding it and putting it away and not worrying about what it does day to day. Too many people worry about markets on a day to day basis versus what is the long term view. I could see silver at 40 this year. I think there's an outside crack that could try to make a run at 50, depending on how it plays out in the markets and depending on what happens everywhere else.
Todd Bubba Horwitz, a veteran trader and member of the CME, maintains a bullish long-term view on precious metals despite current market fluctuations. He expects gold to eventually reach $3,000 per ounce and silver to climb back toward $40. However, he notes that a short-term pullback wouldn't be surprising, and in fact, would be healthy for the broader uptrend. For long-term investors, his message is clear: buy, hold, and tune out the daily noise. Gold is currently under pressure, with prices hovering around $3,330 per ounce in early Asian trading. The weakness is primarily attributed to a stronger US dollar and reduced safe haven demand following President Trump's announcement to extend tariff deadlines, along with renewed openness to negotiations. Still, gold's downside appears to be limited as uncertainty surrounding trade policy continues to keep investors cautious. Market participants remain on edge over the economic risks associated with a potential trade war, making gold an attractive store of value. Despite gold's strength, Citibank has taken a bearish stance, predicting that prices could fall below $3,000 by the second half of 2026. Yet Horwitz remains confident in silver's outlook. He describes the current price action as a normal consolidation phase, suggesting that silver could reach $40 this year. Under favorable conditions, including market instability and strong investor sentiment, he sees potential for silver to challenge the $50 mark. Silver recently closed at $36.91 per ounce, marking a new weekly high. ETF inflows have surged, with over half of the year-to-date net inflows occurring in just the past month. Total holdings now exceed 24,000 tons, valued at $28.5 billion, reflecting growing investor conviction in silver's upside. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, right at the moment, I would rather be short than long. Okay, right at the moment. But again, I'm a big fan. I'm an owner. So let's be clear. When I'm talking about long or short, I own physical metals and I'm not selling them. Okay, but there's times I may have a partial short position as a trade. From a trader standpoint, I think that gold's probably going back to 3,000. Okay, we talked about last time we talked, I said it would get to 3,500. It did. I thought silver would get close to 40. It did. I think they're both going to pull back a little bit, but again, if you're an investor, you should be buying it and holding it and putting it away and not worrying about what it does day to day. Too many people worry about markets on a day-to-day basis versus what is the long-term view. We know the central banks and the Federal Reserve is buying gold because they're trying to protect the currency, which is failing. So again, it's a hedge against inflation. Physical metals are terrific to own. From a trading standpoint, I think they have some room to go on the downside, but I certainly would either, if I was trading them, I'd either short them or wait for an opportunity to buy. But physical metals, I think you can buy anything. I'm a big platinum owner and I'm a big believer. And it's unfortunate that at one time platinum was double gold. Now it's a third of. Actually, it's 2.5 times now. But I think platinum's got a future. Listen, I think they all have a good future going forward. I think that this is just the beginning of a much more extended bull market. But remember, even in bull markets, there will be strong pullbacks. But those strong pullbacks become buying opportunities. So, platinum was between 900 and 1,000 forever, and then suddenly now it's 1,400. Okay, gold's vacillated between 2,700 and 2,800, and suddenly, bang, it was 3,500. So again, you have to be prepared for those things to happen. But if you're not liquid when those times happen, if you're trying to trade as an investor back and forth and time the market, you're never going to be able to do so. And I think the metals are great. I do expect a little bit of a pullback. But again, I welcome pullbacks because those are buying opportunities for me. And I want to be able to be a buyer, which is why you always need to have a little bit on the side. And again, you can't overinvest and you can't over leverage, because if you do, then you're going to be forced to make a bad decision. And I think that's what too many investors do, is they get over leveraged and then they make a bad decision. Very similar to what the government's going to have to do eventually, and very similar to what the banks did in 2008. They got over leveraged. They had to make a bad decision. Unfortunately, they had the taxpayers to bail them out, but the bottom line is they made a bad decision. I really can't. It's so far away right now. I'm just happy it's coming back. I'll be honest. I can't make those kind of predictions because I'd be foolish to tell you that. Based on history, I would say platinum eventually will go over gold. How will it happen? Will gold fall and platinum rise, or will platinum just accelerate? Remember, platinum is a lot less liquid as a product than gold, so it has a potential to explode past gold. If you go back to 2009 when silver went to $49, that was because of lack of liquidity, not for any other reason. And the same thing could happen in the platinum market because there isn't as much liquidity in platinum. So it could overtake gold, but certainly now we're 2,000 points away. So it's not like I'm thinking it's going to happen tomorrow. The silver looks really good. It's just consolidating right now. I could see silver at 40 this year. I think there's an outside crack that could try to make a run at 50, depending on how it plays out in the markets and depending on what happens everywhere else. But we could see another squeeze there as well. And I think there's an outside chance. I say 40, I'm pretty confident we see before the end of the year. I think there's an outside shot at 50. Well, the banks are still stealing from the public. I mean, let's face facts, right? The federal funds rate has come down 100 basis points. The 10-year notes have gone up 100 basis points. That says that the banks are making 200 basis points. The public is not seeing the savings. Mortgage rates are high. They're 7%. So again, at the end of the day, the banks are making the money. They're printing the money. They're putting the money out in the street. And yet interest rates keep going up. It doesn't make a lot of sense, does it? When you think about it. So again, the banks are in trouble. They're well over leveraged, in my opinion. Again, these are just my opinion. I believe that you're going to see something very similar to what we saw in '08. And I think we're getting very close to it now. You can kind of see it by the lack of volume, the retail rally, the way that they're holding up on interest rates, and it's still not enough. And you still have people fighting for lower rates, which again does not benefit the consumer. It only benefits the bank. It's going to turn into stagflation probably. Okay, this is the problem that has been created by the banking system, by the fractional banking, by them allowing to lend what they lend and then overlend. This is caused by our government that continues to overspend, okay, which has to create inflation. I'll give you the best example I can give you, Elijah. 1985, the average income was $25,000 a year. The average house was $80,000. So it's just over 3 times. Today, the average income is $70,000. The average house is $500,000. Over 7.5 times. 7 times versus 3 times. They're not. That's the problem. And when you have a government that continues to spend and spend and spend because they know that the taxpayer is going to pay, and you allow the banks to create new money, which is what they do. Again, when you can lend out 10 times what your reserve is, and it's not even their reserve because they can take the money they borrow from the federal funds, take that liability, turn it into an asset, and then lend out 10 times that amount. So all they're doing is printing new money. It's a whole catastrophe, which is going to once again shock the world at some point. And of course, we'll rebuild and they'll figure out a way to fix it. Because again, if the banks and the stock market actually really fail, and I mean really fail, then we got a lot bigger problems.
The second half of 2025 is shaping up to be a pivotal period for inflation, as it will offer a clearer picture of the impact of President Donald Trump's sweeping tariff campaign. With new tariffs set to take effect, economists and policymakers are closely monitoring signs to see if consumer prices will experience another surge. If inflation reaccelerates while economic growth remains sluggish, the United States could be heading toward a period of stagflation, a troubling combination of stagnant economic activity and rising prices. Federal Reserve Chair Jerome Powell acknowledged this risk during his testimony before Congress on June 24th, noting that the economy could face pressure from both slowing momentum and a resurgence of inflation. While it remains uncertain whether any second-half price increases would be temporary or mark the beginning of a sustained inflationary cycle, the potential for stagflation is increasingly part of the broader economic conversation. Todd "Bubba" Horwitz believes the country is already on the path toward stagflation. He argues that this outcome wasn't accidental, but rather the result of long-standing policy missteps by both the banking system and the federal government. Structural issues, excessive spending, and flawed monetary policy have laid the groundwork for the current challenges. J.P. Morgan Chase CEO Jamie Dimon has echoed similar concerns, stating that he cannot rule out the possibility of stagflation. With global supply chains still strained, geopolitical tensions flaring, and domestic fiscal pressures mounting, the risk of a prolonged period of high inflation alongside tepid economic growth has become a central concern for both Wall Street and Washington. Let's get back to the interview.
I mean, listen, the markets are extremely overbought, Elijah. And typically when this happens a lot at the end of cycles. And again, the rally that we've seen the last couple of weeks has been really driven by retail traders. You have very little volume, you have very little volatility, which tells you that it's retail that's buying and that the big houses, JP Morgan, Goldman Sachs, they're not really participating right now. You saw a little bit of a panic this morning when there was more tariff talk and the market sold off. Now, it wasn't an ugly sell-off. I mean, you're talking about 1%, which is really nothing to even think about. But it is a sign that we should see some more selling and some follow through here. And we could have reached potentially a top. And I'm not predicting a top. And I don't want anybody running out and getting short now. But certainly there's a lot of reasons to believe that we are very near, if not at a top, very near to. And there's a lot of reasons that we could see some heavier selling. And of course, we have earnings season right around the corner, which could be the impetus to start pushing these markets back down because they are a little bit overextended to the upside. Well, just for technical reasons, double tops don't work well in an uptrending market. So we need another reason, another technical indicator. But yes, we are reaching or appearing near a resistance area of the market. We are very overextended. But this whole rally that we've watched since the sell-off in April, if you look at the volume was very heavy through April on the selling. Subsequently, we've gone up and we're trading at about 40% of normal volume now. Now, we've had lower volume in general, so it's harder to really compare. But when the volume dries up, that tells you that retail is buying. And when retail is the only buyer in town, that typically means that there's an event going to happen. It could be the tariffs on Wednesday. There's a lot of things that can happen between now and these markets that could really force them down, because once the panic starts and the volatility starts to pick up, that'll attract new money sellers, which is the funds that are sitting on the sidelines, the Goldman Sachs of the world, the JP Morgans of the world. I mean, there's a lot of winners and losers in the bill. I'm not a fan of the bill itself because I'm not a fan of spending, right? We want the government to quit spending because government doesn't make money. They make debt. They make taxpayers pay more. So the rich benefited greatly, who always benefit. The poor got slaughtered, and the middle class, there's some good and some bad. But listen, if you're a waiter or waitress or you live on tips, you don't have to pay tax on those tips anymore. Seniors got a benefit. So there's a lot of good and bad, but the bad of the whole thing is more spending. Okay, we don't need to spend more. We need to cut spending. And I find that to be a problem with the bill in general. Although I'm a fan of the president, I do think that the spending's got to stop and the begging for lower interest rates has got to stop, because the only reason they want rates to go down is so we have a lower debt service so they can spend more money, versus putting our house in order and getting us back to somewhat of balance and quit spending all the money that our hardworking taxpayers pay. That I'm always 100% invested in the stock market, right? I mean, I would say, let's say if you want to break it down, I'm 80% stocks, 20% metals. Okay, I don't sell. I continue to buy. There's ways to hedge your portfolio, and there's an old saying, an old adage, it's not timing the market, it's time in the market. Because over time, just like gold and silver, they've gone up over time. The stock market has gone up 8.5%, and since the day in history it started. So think about that in real terms. If you're always invested, okay, you're going to make money over time. That's why you have to invest with money that you have, that you can afford, and don't have to look at it every single day. Okay, people are looking at their 401ks and IRAs every day like they're going to sell them. You cannot invest like that because you'll give yourself a nervous breakdown. Well, I mean, we have a strategy. We actually use derivatives to hedge our portfolio. So I know on any given day, I can tell you the exact amount of risk that I'm exposed to. And for example, my portfolio is exposed to 5%, which I'm fine with. And if that 5% hits, I'm buying more. And I'm going to roll down my hedge and buy more assets, because that's, again, you have to understand the theory and the idea behind compounding. Okay, you want to buy into weakness, just like when gold was going down last year, we were talking about buying it. Why? Because you have to be able to buy into weakness, which means you have to have money aside to be able to step in when it looks the bleakest, is when you want to be the biggest buyer. That tells you that we're in a recession, Elijah. That tells you that the little guy is hurting very badly here. The middle class is in trouble. They're not allowed. They don't have money to buy gold. Many of them have given up on their 401ks because they can't, and they're giving up 4% of their own income because they can't afford to support it because of the high inflation. So that's what's going on here. And this is, once again, you hear it all the time. The rich get richer because they can take care of opportunity. So they're buying at a low premium. Price is high, so what? They're buying at a low premium to spot, and they're happy to store it and hold it because they can afford to do so. And I think that's something that you have to understand as a trader, as an investor, and as a person, that it's very important that you always take care of yourself first and you make sure that you've got assets that you can put away. You need to, just like the government has to balance your budget, you as a person have to balance your own budget so that you can have money put away so that you have gold and you have silver that grows in time, that becomes worth more.
Rarely do markets find themselves navigating such conflicting cross-currents: rising tariffs, uncertain monetary signals, and escalating inflation fears, all converging in a fragile global economy. As whispers of stagflation evolve into louder warnings, traditional hedges like silver and gold are back in the spotlight. Even as banks hedge their bets with cautious forecasts, longtime commodity traders see this turbulence as fertile ground for explosive rallies. The real question may no longer be if precious metals break out, but how dramatically they respond to systemic stress. Are we on the verge of a renewed bull cycle in gold and silver, or just witnessing the early signs of something far more volatile in the global economy? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.